Hello. This is the 34th episode of What Would Peter Lynch Do?, which explores the wisdom of legendary investor Peter Lynch. A listener asked, many people have made money with inverse investments. Should I try it? Following the question about leveraged products last time, this is one of the products that, well, individual investors seem pretty crazy about. So today, we're diving deep into inverse investments. Our mission is to unpack exactly what they are, why they might seem appealing, and, crucially, what Peter Lynch and other investment masters would likely say about them. Especially, for someone who's just starting out in stock investing.
Yeah, that's a great question from the listener, and it's one we hear quite often, actually. The allure of inverse investments is definitely strong. I mean, the idea of making money when the market's tanking, it feels almost like a superpower, doesn't it? But yeah, we'll take a clear, impartial look at both that appeal and, probably more importantly, the significant risks and nuances involved.
Right, because on the surface, profiting when everything else is going down, I mean, it sounds like the ultimate financial hack. But we know there's rarely a free lunch in investing. So what's the immediate red flag? What should pop into your mind when you hear inverse ETF?
That red flag is crucial, and it leads us straight to the core idea of what an inverse ETF even is. So at its most basic level, it's a financial product specifically designed to move in the opposite direction of whatever asset it's tracking. So take an S&P 500 inverse ETF, for example. If the S&P 500 index, the one tracking 500 big U.S. companies, falls by 1% in a single day, this inverse ETF aims to give you a 1% return for that day.
Okay, so the opposite.
Exactly. And conversely, if the index goes up by 1%, the inverse ETF would lose about 1%. The goal from an investor's point of view is pretty straightforward: profit when you think the stock market's going to head down.
Okay, makes sense as a concept. But you mentioned significant risks. What's the catch?
The biggest one, the one you absolutely have to understand, is what's often called the compounding effect trap, or sometimes the negative compounding effect.
Right.
And this trap comes directly from how these things are built. They track the daily return of the underlying asset. That daily part is key. It can cause, well, serious problems if you hold on to them for anything more than a really short time. Let's walk through a quick example and makes it clear. Imagine the S&P 500 index starts at, say, $100, and an inverse ETF tracking it, let's just call it ADC, also starts at $100.
Okay, both at $100.
Right. Day one, the S&P 500 climbs 10%, goes from 100 uppos up to $110. Since ABC is inverse, it does the opposite. It falls 10%. So it goes from $100 down to $90. Simple enough so far.
Yep, got it.
Okay, now day two. The S&P 500 falls back down to $100. Now remember, it's falling from $110. So $110 back to $100, that's actually a drop of about 9.1%.
Right, because the base changed.
Precisely. So ABC, being inverse, should go up by that 9.1%, but it's starting day two at $90. So you take $90, multiply it by 1.091, and you get $98.19.
Wait a minute, let me just make sure I'm following this because it feels weird. The S&P 500 started at $100, went up, came back down, ended right back at $100, broke even over 2 days. But the inverse ETF ABC, it started at $100 and ended day two at $98.19. So it lost $1.81.
That's exactly right.
How? Why? Is it because those percentages are always working off a different base value each day? Like the inverse fund's value keeps shrinking, so the gains don't match the losses?
You nailed it. That's precisely the issue. The index returned to its starting point, but the inverse ETF lost money. It's because of volatility. The simple act of the price going up and then down, even if it nets out to zero for the index, that movement itself erodes the value of the inverse ETF over time. This means, and this is critical, you can actually lose money holding an inverse ETF even if the market just trops around sideways, or like in our example, ends up exactly where it started.
Wow. Okay, so given that kind of inherent decay, it's obviously not something for a typical buy and hold investor. So who are these things actually for? Is there anyone who should be using them?
Well, based on that decay and the daily reset, it's fair to say inverse ETFs are highly unsuitable for long-term investors who believe in the long-term upward trend of the stock market. I mean, fundamentally, they are primarily tools used by, let's say, sophisticated investors, and really only for short-term objectives. There are basically two main ways pros might use them. One is short-term hedging.
Hedging, like insurance.
Kind of, yeah. It means buying a small amount to try and protect against a potential drop if they think there's a risk of a short-term plunge in their main stock portfolio. The other way is short-term speculation, basically betting on a market crash over a very short period if they have a really strong conviction it's about to happen.
Okay, so very specific, very short-term uses. Now, last time we talked about leveraged ETFs, the ones that try to magnify returns. Do these inverse products share similar kinds of Structural problems or risks?
Yes, absolutely. That's a great connection to make. Both leveraged and inverse ETFs share the same structural risk, the trap of compounding based on daily returns.
Hmm.
They really are two sides of the same tricky coin when it comes to the dangers for individual investors.
Hmm.
I like using bicycle analogies for these. Think of a leveraged ETF, maybe a 2x or 3x one. It's like riding a bicycle that's 2 or 3 times faster than others because you are convinced the road ahead will be continuously uphill. If the road is indeed all uphill, great, you'll arrive first. But if there's even a short downhill stretch, or if it just goes up and down a bit, you'll actually fall behind someone on a regular bicycle because of that compounding effect working against you on the down moves.
Okay, that makes sense. What about the inverse one?
The inverse ETF. It's like being sure the road ahead is all downhill and riding a special bicycle that moves forward when you pedal backward. Oh, if the road is continuously downhill, fantastic, you can cruise comfortably. But if it suddenly becomes uphill or even just flat, for even a moment, pedaling backward becomes completely meaningless, right? It just wastes your energy. The structure stops working for you.
Those analogies really highlight the dependency on perfectly predicting the market's path. So what are the main sort of common difficulties that individual investors face when they try to use either of these products?
Yeah, there are 3 big shared problems. First, as you hinted, is the need for precise timing. You basically have to predict almost perfectly when the market will move, which direction it will move, and how strongly it will move. If your timing is off by even a day or two, those losses from the compounding effect start piling up immediately. And let's be honest, getting that timing right consistently, it's nearly impossible, even for professional traders.
Okay, timing is hurdle number 1. What else?
Second, their unsuitability for long-term holding. Look, historically, the stock market tends to trend upwards over the long run, right? But it does so with lots of ups and downs along the way. Volatility is normal. But for leveraged and inverse ETFs, that volatility, those ups and downs, acts like a poison. It constantly erodes their value over time due to the daily reset. So they are the absolute opposite of a buy and hold long-term investment strategy.
Right, the decay factor again. And the third difficulty?
The third one is psychological. It's the psychological pressure of losing more when you lose. With leveraged ETFs, if the market drops, you lose 2 or 3 times as much. That hurts. With inverse ETFs, you lose money when the market goes up. Imagine the feeling everyone else is making money in a rising market and you're the only one losing. That kind of psychological pressure makes it incredibly hard to think clearly and make good decisions. Really, these products are much closer to tools for professional traders than they are for typical individual investors.
Okay, so professionals use them for very specific short-term things. But let's say an individual investor hears all this, understands the risks, but still insists they want to use one, maybe for that hedging idea. What's the absolute safest, most limited way they might approach it? And maybe step back, why were these things even created? Who asked for them?
Yeah, good questions. If an individual insists, then a very cautious approach is needed. Seriously. And the use case is almost exclusively limited to short-term risk management hedging purposes, not for making big bets. Let's paint a picture with that example scenario you mentioned. Imagine you've got a $50,000 portfolio. It's mostly solid, blue chip, U.S. stocks, Apple, Microsoft, Nvidia, that kind of thing. You intend to hold them long term. But, there's a big Fed interest rate announcement coming next week, and you're genuinely worried it might cause a sharp but temporary market dip.
Okay, common scenario.
Right. Now, the wrong choice would be to panic and sell all your great long-term stocks just because you're nervous about 1 week. You'd likely miss out if the market surprises to the upside, plus you might create tax headaches.
Right. Don't sell your core holdings out of fear.
Exactly. So here's the very limited use case for hedging with an inverse ETF. You might decide to buy a small amount, say, just 5% or 10% of your portfolio value, so $2,500 to $5,000 in this case, of a simple inverse S&P 500 ETF. Let's use the ticker SH, which is a NACD1X S&P 500 fund. Now let's see what happens. Scenario 1, the market does fall 5% after the announcement, just like you feared. Your main stock portfolio loses about $2,500, 5% of $50K. But your small inverse ETF position profits by about 5% of its value, so roughly $125 to $250. See, the inverse ETF profit partially offsets the loss on your main holdings. It acted like a little bit of insurance.
Okay, it cushioned the blow slightly. What if you were wrong?
Scenario 2. The Fed news is good. Market rallies 3%. Your main stock portfolio is up about $1,500. 3% of $50. Great. Your inverse ETF position, however, loses about 3%, so maybe $75 to $150. In this case, that small loss on the inverse ETF is basically the insurance premium you paid for the protection you didn't end up needing. Your main portfolio still had a good gain overall.
Got it. But what's the catch even with this hedging use?
The absolute critical point is this: that inverse ETF position must be sold immediately after the event, like right after that Fed announcement is digested by the market. Holding it for more than a day or two is very risky due to the compounding effect trap. You use it for the specific event risk, then get out. It's not a hold strategy.
Okay, that makes the narrow hedging application much clearer. Very short term, very specific purpose. So back to the why. If they're this tricky, and mostly for pros, why did they get developed? Who benefits?
Well, they certainly weren't developed with the goal of helping average individual investors build long-term wealth. That wasn't the primary driver. Think about the development background. Before these ETFs existed, if you wanted to bet on a market decline or manage short-term risk like hedging, you generally had to use things like futures contracts or options. And those are complex, right? They require special knowledge, margin accounts, they have expiration dates. They're just not easily accessible for most people.
Yeah, definitely more involved.
So financial engineers basically created these leveraged and inverse ETFs as a way to package that kind of exposure, betting on direction, magnifying returns into a simple format. They're essentially a derivative product that anyone can easily buy and sell like a regular stock on an exchange. They simplified access to these kinds of trading strategies.
So who is the ideal user then, the one the designers maybe had in mind?
The real target audience, the ideal user, are folks like hedge fund managers, institutional investors, professional traders. Their purpose for using these isn't long-term investing. It's things like short-term arbitrage, trying to profit from tiny price discrepancies, fine-tuning of complex portfolios, or doing that sophisticated risk management hedging for specific events we talked about. And critically, these users have the knowledge. They have a perfect understanding of derivative structures, market mechanisms, and the compounding effect trap, volatility decay. They know exactly how these things work and, more importantly, how they can fail. Their trading style reflects this. They might enter a trade with a very strong conviction, like it will definitely go up down today, and they plan to close that trade within minutes, hours, or maybe at the absolute most, a day or two. They never hold for the long term.
Right, in and out quickly.
Exactly. And they have the resources, the time, the sophisticated systems to monitor the market constantly, 247, plus complex analytical models to help them make those calls.
It really sounds like a different world from typical investing.
It is. That's why the Formula One racing cars analogy works so well. They deliver top performance when driven by a professional driver on a circuit, but they are too dangerous and inefficient for an ordinary person to drive on public roads for their daily commute. So, for most individual investors, the way to protect your assets is to understand these products as special professional tools. Maybe interesting to know they exist, see a different side of the market, rather than seeing them as the holy grail of investing, and to keep a safe distance.
That Formula One analogy is powerful. High performance, high risk requires professional skill and the right environment, not for the daily drive. Okay, so if these are pro tools, fundamentally at odds with long-term, understand what you own investing.
Yeah.
What would Peter Lynch himself likely say? Did he ever comment directly?
You know, it's actually difficult to find materials where Peter Lynch directly commented on leveraged or inverse ETFs by name. They became much more popular after his main tenure at Magellan. However, if you just look at the absolute core of his investment philosophy, it becomes pretty clear where he'd stand.
How so?
Well, his most famous principle maybe is invest in what you know. Right. Put your money in companies whose business you can actually understand, whose products make sense to you, whose growth potential you feel you can grasp. Now, think about the complex structure of these ETFs, the daily resets, the swaps and derivatives often used behind the scenes, the compounding decay. It's pretty much the definition of something that's not easy to understand. It's far from this philosophy.
Right. It's the opposite of buying stock in a company you understand.
Exactly. And then there's his whole goal of finding 10 baggers. His entire focus was on finding great companies and holding them for the long term, letting them compound and grow your wealth significantly over years. That is the complete opposite approach to short-term products whose returns are settled daily. These ETFs are designed for quick bets, not long-term compounding. So given his emphasis on understanding, simplicity, and long-term holding, Yeah, it's reasonable to assume that Peter Lynch would never have recommended leverage inverse ETFs, which bet on short-term market volatility, to individual investors. They just don't fit his framework at all.
His silence, in a way, speaks volumes then. They just don't align with anything he preached. So if Peter Lynch likely wouldn't touch them, what about other investing giants? Did they offer any wisdom that applies here, warning against this kind of short-term timing-dependent strategy?
Oh, absolutely. Other masters have been very vocal about principles that directly contradict the approach needed for these products. First, you've got Warren Buffett. His constant advice: don't try to predict the market. Simple as that. He famously said, the stock market is a device for transferring money from the impatient to the patient. For Buffett, trying to guess short-term market moves, which is exactly what leveraged and inverse ETFs require, is pure speculation, not investing. He believed the odds of succeeding at that consistently are incredibly low. His focus is always on owning great businesses for the long haul.
Patience over prediction. Makes sense. Who else?
Then there's John Bogle, the Vanguard founder, the father of index funds. He was a huge critic of anything that encouraged frequent trading. His mantra was basically, trading is the investor's enemy. He felt it just generated costs and taxes, hurting long-term returns. He even had a really sharp analogy specifically about ETFs, particularly the more complex ones. He said, ETFs are like the famous Purdy shotgun, great for killing big game in Africa and great for suicide.
Wow, that's blunt.
It is. But his point was that while they can be powerful tools in the right hands, like the big game hunter, they can also be incredibly dangerous if misused. The suicide risk. He worried they made speculation and frequent trading too easy. He championed long-term investing by the market, keep costs low, hold on. Trading complex products was the exact opposite of his philosophy.
Bogle's analogies always cut right to the chase, don't they? So the classic master is pretty clear. Avoid market timing, be patient, keep it simple. What about more modern investment thinkers? Do people like Howard Marks or Morgan Housel echo these warnings, maybe with a slightly different angle?
They definitely do, and their perspectives, often focusing on behavior and psychology, add another important layer. Howard Marks and Morgan Housel are, particularly relevant here. Howard Marks, famous for his Oak Tree memos, constantly pushes for second-level thinking.
Second-level thinking. What's that versus first level?
Okay, so first-level thinking, according to Marks, is simple, superficial. It's the obvious thought, like, the market seems like it's going to crash, so I'll make money if I buy an inverse ETF. It's easy. Anyone can think that. Second-level thinking is deeper, more complex. It questions the obvious. It asks things like, okay, if everyone is expecting a market decline, isn't that expectation maybe already priced in? Am I too late?
Wow.
Or, wait, these inverse ETFs have that structural decay problem from volatility. What happens if the market just bounces around for a week but doesn't actually crash? Won't I lose money anyway? It also asks, if I am wrong about the market call, how bad could my losses be? Is the potential reward really worth that risk? And maybe critically, why did the companies create this product? Who's making money here consistently? Hint, often it's the issuer, from fees and trading spreads. So, for Marks, just jumping into an inverse ETF because you think the market will fall is a classic example of first-level thinking for most individuals. They haven't thought through the complexities and probabilities.
That's a really useful framework, thinking beyond the obvious appeal. What about Morgan Housel? His focus is more on psychology, right?
Exactly. Morgan Housel, who wrote The Psychology of Money, argues that so much of investing success is about behavior. It's a psychology game. And from his perspective, products like inverse ETFs are dangerous precisely because of how they mess with our psychology. First, they are the enemy of patience. They tap directly into that very human urge to get rich quick, to find a shortcut. But Housel constantly reminds us that real wealth building comes from compounding over time and patience. These products encourage impatience.
Right, try to compress gains into days instead of years.
Precisely.
Yeah.
Second, he talks about misleading storytelling. The story, make money even when the market falls, sounds fantastic, right? It's compelling, but it cleverly hides the uncomfortable truth, which is often something like, my money melts away from volatility alone, even if I guess the direction right eventually. The narrative glosses over the decay. And finally, they can lead to amplification of regret. Getting a bet wrong with these products can lead to huge, rapid losses, or, as we said, losing money while everyone else is gaining. This kind of intense regret often triggers the absolute worst investment decisions, such as panic selling at the bottom or chase buying, desperately trying to make the money back. It throws your whole long-term plan off track.
So between the structural flaws, the need for impossible timing, and the psychological traps, The case against these for typical investors seems overwhelming.
I think that's fair to say.
Okay, this has been incredibly clarifying and really stripping away the surface appeal to show the underlying mechanics and risks. If you had to bring together all these threads, Peter Lynch's likely view, Buffett, Bogle, Marx, Hasselhoff, what's the single most important takeaway message you'd want our listener, especially someone new to investing, to remember about inverse investments?
I think the unified message echoing across all these great investors, both classic and modern, is this. Successful investing is not a game of finding shortcuts, but a marathon of controlling your emotions and behavior while sticking to long-term principles. It's about patience, discipline, understanding value. Leveraged and inverse ETFs, by their very nature, are short sprint tools that are in direct opposition to these marathon principles. They encourage timing, complexity, and emotional decision-making. And because of that, they are very likely to lead most individual investors not to the finish line, but to a ditch on the side of the road. The safer and wiser path, especially for someone starting out, is almost always going to be steadily buying and accumulating good assets that you can understand, blue chip companies, market indexes, and growing your assets from a long-term perspective. Focus on the marathon, not the dangerous sprint.
That's a powerful closing thought. Brings us back to core principles. I'll say a word from Peter Lynch today. The stock market is filled with individuals who know the price of everything, but the value of nothing. And I think that principle connects not only to investment decisions like avoiding these complex price-focused products, but also to broader life wisdom. It reminds us not to get caught up in the hype, the complexity, the short-term noise, whether in markets or life, but to focus on understanding genuine, underlying value and having the patience to let it grow. It's about substance over shortcuts. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.